Make sure everybody's here. Thank you, Manon. All right, can you guys see my screen?
Yes, ma'am.
All right, so yesterday we talked about, started talking about withholding. We're gonna get into it deeper today. Hope you have your calculator and brought your math nerd brain because we're gonna do some math today. I'm very excited about it because I am a math nerd. Okay, so the most common method that's used to calculate federal withholding is the percentage method. It's more flexible than the wage bracket method, which we looked at yesterday, because it can be applied to payrolls that are not on, that are on maybe different schedules, like semi-annually or quarterly or annually. And it can be applied to wages that exceed the wage bracket tables. So that's why it's a popular method. So the publication 15T is where all of the pertinent information that you need to calculate all of this is. So if you don't have that bookmarked in your web browser, you probably want to bookmark it so that you can use the publication 15T, which has all of the tables that are going to be relevant to you. And those will be available to you for the CPP exam. All right, so this is really one of the worksheets that they provide to you that we have to use to figure out how we're going to actually withhold, or how much we're going to withhold from our employees' checks for federal withholding. So the first step is to figure out their adjusted wage amount and determine the taxable wages for the pay period. So again, remember that if you're determining taxable wages, you have to take their, whatever they're being paid, gross pay, and you have to reduce it by anything that's considered pre-tax. So for federal taxable wages, we're going to reduce it by any of your section 125 deductions, like medical, dental, vision, anything like that that is included in a section 125 plan and so considered pre-tax. You're also going to reduce it by any deferred compensation that is traditional, so not Roth, because Roth is considered after tax, but anything that's a traditional deferred compensation, 401k, simple IRA, things like that. So you're going to determine the taxable wage. From there, you're going to find the row in the percentage method table for the range that the adjusted annual income falls within. And I don't have a picture of that on this slide, but we will look at that when we're doing examples. And then you're going to do some math and figure out the numbers that go into this table that you're seeing now. During step 3, you're using to determine whether the tentative amount that they're going to be withholding, and then we're going to take into account any tax credits that the employee might be eligible for dependents, which is going to be tracked on their W-4. And then from there, we're going to look at step 4, which adds any additional amount that they may want withheld. So this hopefully will make much more sense as we look at an example. So here's that table that I was talking about that you're going to find and have to use when you're using the percentage method. They do give you resources. This piece that's outlined in blue right here that says an electronic examination supplement containing every table required to correctly answer some questions will be provided in the computer software. That's directly from the CPP booklet. That's the verbiage that they say they're going to give you the tables to be able to actually do these calculations. So don't think you need to memorize this whole table. Don't think you need to memorize this whole worksheet. They're going to give you that information. You just have to know how to utilize it and where to put the numbers. So that being said, let's jump right in and do an example together. So Sharon is paid $2,350 bi-weekly. She claims married, filing jointly, and $2,000 in step 3 and $50 in step 4C on her 2020 Form W-4. So in that statement, they've given us everything that we need to be able to complete this worksheet and figure out her taxes that we're going to withhold for federal taxes using the percentage method. So step 1, line 1A, we're going to enter the employee's total taxable wages this payroll period. They didn't tell us she had any pre-tax deductions, so we assume she doesn't have any. So what we're going to put on that line is simply her wage of $2,350. Line 1B, we're going to enter the number of pay periods you have per year. They tell us that she is paid bi-weekly. which means that she's paid 26 times per year. Again, that's very important for you guys to know, biweekly, 26 times a year. Line 1C, I told you guys yesterday that we're going to annualize things. So that's what we're doing right now. We're taking what she's being paid on this biweekly pay period and we're multiplying it by the number of times she's going to be paid that amount per year, which is 26. So if we do math, hopefully we did math correctly, and 2,350 times 26 is 61,100. Jumping right down into the next piece, it says if the employee has submitted a Form W-4 for 2020 or later, then we're going to use this section, this next section. She does have a Form 2020 or later, so that's the section we're going to use. So line 1D says enter the amount from step 4A of the employee's Form W-4. So we're going to go 4A. They didn't tell us she put anything on that line in the information they gave us, so we have to assume it's 0. If they didn't tell us, we have to assume it's 0. So we're going to put 0 there. Add lines 1C and 1D. So we're going to say that's our adjusted annual gross income. So just to remind you, what goes on step 4A of the employee's W-4 is if they anticipate getting any annual income that we're not taking into account from their wages. So we're going to say, based off of them not telling us that they put anything on that line, we're going to say it's 0. Therefore, we're assuming that this person's annual income is going to be about 61,100 for the entire year. Based off of that information, again, we're going to enter from step 4B on the employee's Form W-4. Again, they didn't tell us anything about step 4B, so we assume it's 0. If they don't tell us, we have to assume it's 0. If the box in step 2 of Form W-4 is checked, enter 0. If the box is not checked, enter 12,900 if the taxpayer is married filing jointly, or 8,600 otherwise. So they tell us that she is claiming married filing jointly, and they did not tell us that she checked the box. So we're assuming she did not check the box, which means we're putting 12,900 on that line. Okay. Again, just make sure you're reading carefully and taking the time to go through these, and you will do fine. On line 1H, we're adding lines 1F and 1G, which just gives us 12,900 because line 1F was 0. And then line 1I, we're subtracting line 1H from 1E. If 0 or less, enter 0. And this is the adjusted annual wage amount. So based off of all of this information, we're assuming that her adjusted annual wage amount is 48,200. Basically, that's her annual wage minus any standard deductions that she's going to be allowed to take because she didn't have any adjustments on her W-4. Okay. The next section says if the employee has not submitted a Form W-4 for 2020 or later. So this means if the employee has been employed with you for a while and they have a previous W-2 from 2019 or before, which they can have because you're not required to make them fill out a new W-4 every year. So they can have an earlier one. And so this table takes that into consideration. In our case, we're going to ignore those lines because they do have a W-4 that's from 2020 or later. So we're going to ignore that piece of the table for now. Whoop. Okay, so the next part is step 2, and we're going to figure out the tentative withholding amount based off of the information that we have. So line 2A says enter the employee's adjusted annual wage amount from line 1I or 1L above. We're using 1I because they're using a Form W-4 from 2020 or later. So we're going to go ahead and just enter 48,200 on that line. Then you're going to find the row in the appropriate annual percentage table in which the amount on line 2A is at least the amount from column A, but less than the amount in column B. And we're going to enter that amount from column A on line 2B. So I have your table up here, and we're going to find that amount. I thought I had it squared, but apparently it didn't. So anyways, it's the second line down that's going to be between 32,100. I guess it's the third line down if you count the first line. 32,100 and 93,250. Okay, so we're putting the amount from column A on line 2B. So that's 32,100. Enter the amount from column C of the same row. So column C is $1,990. Enter the percentage from line D, which is 12. subtract line 2B from 2A. So we're going to take our 48,200 and our 32,100, and we're going to find the difference. That's 16,100. We are then multiplying that amount by the percentage. Again, remember how to change a percent into a decimal. 12% is 0.12 as a decimal. You're moving that decimal places, the decimal 2 places. If we do that math, we get $1,932. And then we're going to add lines 2C and 2F. So we get $3,922. We are then going to divide that amount. So that's, again, we're talking about a per pay period amount versus an annual amount. So we took our per pay period, we annualize it. Now we have our annual amount that we should withhold. Now we need to take it back down to a per pay period amount. So we're going to take that 3,922. We're going to divide by 26 pay periods, and we should withhold $1,050.84. Step 3 is to take into account for any tax credits that this employee is going to claim. Back up to our original information, she claimed $2,000 in step 3 on her W-4. So we do need to know that information. So we are going to enter 2,000 on line 3A because that's what she put on her W-4. That's an annual amount. So we now have to take that down to a per pay period amount, and we're going to divide by 26 and get $76.92. That's the amount of the tax credit that we're going to take. Then we're going to take 3B and subtract it from 2H. So we were going to withhold $150.84, but she has a kid, so she gets a credit for that. We're only going to take $73.92 because of her child credit that she gets. Step 4 is taking into account any additional adjustments that we have on the W-4. So 4A says enter the additional amount to withhold from the employee's Form W-4. Step 4C, which she told us was $50. And then you're going to add lines 3C and 4B. So we get $123.92.
I have a small question on this. So back up on 2H, when you got 150.84.
Yep.
My calculator, when I divided 39.22 divided by 26, I got a decimal that went out farther. So I noticed it didn't round. So we should not round on this. I got 150.8461. Oh. I don't know how detailed, if that matters. I mean, it's a one, it just matters down on step 3.
Right. No, I agree with you. I would have rounded to 85 cents instead of 84 cents.
Okay.
But I don't think that, I mean, that's not going to make that big of a difference.
Okay.
But yes, I would agree with you. I would have rounded.
Okay. So rule of thumb, so don't worry, so keep rounding this as well. Okay.
Yeah. Yep.
Okay, cool beans. Thanks.
You're welcome. So this isn't terrible. It's just kind of tedious, and you have to make sure you put everything in the right spots. Okay. Oh, there's that box that I thought was going to come up a lot sooner around the table. So, all right. So here's a pop quiz. Here's a similar scenario, and we're going to do this together. But go ahead and we'll have you type your answer in the chat so that we make sure everybody gets credit. So an employee earns $5,557.19 biweekly. They claim married, filing jointly with 5 dependents under the age of 17 on a 2021 Form W-2. That translates to $10,000 in step 3. For those of you that don't know, the child dependent, I shouldn't say child, the dependent credit is 5 times 2,000 per child. So that's how they get the 10,000. Using the percentage method tables for automated payroll systems, calculate the federal income tax withheld each pay period. So again, I said we were going to do this together. So here's our scenario again with our table. So on 1A, we're going to enter the total taxable wages this pay period. They didn't tell us about any pre-tax deductions, so we assume that we don't have any. So on line 1A, we're going to do $5,557.19. 1B is the number of pay periods. So we're going to get 26 because this is a biweekly payroll. Line 1C, we're going to multiply those together to get an annual amount. So annually, this person is going to make $144,486.94 if this scenario happened every single pay period of the year. The next piece, we're going to use that section for the form 2020 or later W4 because we have a 2021, I believe, W4. So on line 1D, we're going to enter the amount from step 4A, which they didn't tell us they put anything in that section, so we're going to say 0. Then we're going to add, which means we just get $144,486.94. 1F, we're going to enter the amount from step 4B. Again, they didn't tell us about anything, so we're going to assume that 0. In line 1G, if the box in step 2 is checked, enter 0. If the box is not checked, enter 12(9) if the taxpayer is married filing jointly or 8(6) otherwise. We know that they're married filing jointly and they did not tell us anything about them checking the box, so we're going to say 12(9). We're going to add lines 1F and 1G, again getting 12(9) because our 1F was 0. Now we're going to subtract 1H from 1E, and we're going to get our annualized adjusted annual wage amount. That next section we get to skip because this person has a 2020 Form W4 or later. Step 2 of the worksheet, we're going to figure out the tentative withholding amount before we make any adjustments. So we're going to enter that same amount, $131,586.94. We're going to find the row in the percentage method table that corresponds with that number. Maybe I put the box on this one. Nope, I didn't put the box on this one either. Sorry. Terrible at this. So that falls into the 4th line down. So we're going to put 93,250 because that's what's in column A. Then we're going to enter the amount from column C of that same row, which is 9,328. We're going to enter the percentage from column D, which is 22. Then we're going to subtract 2B from 2A. We get 38,336.94. Then we're going to multiply by the percentage on 2D, and we get 8434.12. We're then going to add 2C and 2F, and we get $17,762.12. And then we're going to divide that out by 26 and get $683.15. Looking at step 3, we're going to enter the amount from step 3, which was 10,000. That's the dependent credit. We're going to take that amount and divide it by 26 to get the per pay period amount. And then we're going to subtract. So we were going to withhold $683.15. Now we're going to take away those dependent credits and we're only going to withhold $298.53. The last section asks about any additional amounts that we're going to withhold. They didn't tell us about any, so we're going to assume it's 0. Therefore, the amount we're going to withhold from this person's wages is $298.53. So I helped you cheat, make sure that we get credit for you participating. So go ahead and make sure you put your answer in the chat with your name.
I really like the way you go through that, Melissa.
Oh, thanks.
It should really help people take the test.
I hope so. I just wish I was better at putting the box that I wanted to put. Oh, there it is. See, at the end again. I think people get really intimidated because it seems like so much work and so much math. It's really not that bad as long as you take it one step at a time and you read carefully and you make sure you're putting the right numbers on the right lines. So.
And reading through the W4 and learning to go step by step should also help people read through the test and make sure you're, because you know it's all set up so similar as far as making sure that you're understanding exactly what they're asking for.
Yeah. Rebecca took this test last spring, so she's taken it pretty recently, and you have to make sure you read very carefully. They try and trick you. They put words in there like always or never, which, you know, throws you off. We all know those are trigger questions in a test scenario that could affect the answer that you're presenting. So yeah, just take your time. You guys will be absolutely fine.
Don't you have 4 hours and it's like 190 questions and then like 25 extra questions in there? So
I believe so. There's yeah, I have a breakdown and I can figure that out and throw it in there tomorrow, but I know I have a breakdown on our last week of the study group. I show a breakdown of the types of questions, but there are somewhere in there 25 or 30, something like that, questions that they don't even grade. They're in there to basically see what you answer. And then the rest of the questions are graded. What's hard is, and it's very frustrating for people like me that want to know how I did. I want a percentage. I want to know if I got 90% or 95%, or if I barely squeaked by with an 80%. You know, I want to know what I got when I passed, but they don't tell you what you got. You get a pass fail. It doesn't tell you. So, which is really frustrating to people like me. So
Yeah, so it needs to be 80%.
I believe so. I can find that when you guys are doing your next test question. I'll find that in the booklet. Okay. All right, so there was your answer, 298.53. Good job. So the optional flat rate and the mandatory flat rate method are pertinent to supplemental wages, and supplemental wages can be anything from tips, overtime, bonuses, back pay, commissions. There's a ton of things that can be considered supplemental wages. The most common one is definitely going to be a bonus. That's what most of us think of as supplemental wages. So that's what most of my examples are for. The optional flat rate method does anybody know the percentage for 2021? It's the same as 2020, if that helps.
22%.
It is 22%. Good job. That's if you've made less than $1 million in supplemental wages. If you have made more than $1 million in supplemental wages, it is 37%. I don't know anybody in that boat, but I definitely want to be friends with them if there is somebody in that boat. So again, that's the mandatory flat rate method. That means if you've had year-to-date supplemental wages paid in excess of $1 million a year, you now have to have the mandatory flat rate method, and it's 37% withholding. So an employer works for 2 employers owned by a common parent company. The payments made by both employers must be aggregated to determine if the $1 million of supplemental wages has been met. If the employee was paid $750,000 in supplemental wages by one related employer and $350,000 in supplemental wages by another related employer, then $100,000 of those supplemental wages is subject to the 37% mandatory flat rate. Anything over that $1 million. Okay, so the optional flat rate method is anything if the employee has been paid less than $1 million, which is most of us in most scenarios that you're going to come across, then the flat rate method is 22%. This can be used if income tax has been withheld from the employee's regular pay during the current or preceding year, and the supplemental wages are not paid concurrently with regular wages by the employee. Or if they are paid concurrently with regular wages, they are on a separate check or a separate payroll record. So let's look at an example. Carol, who claims married with 2 allowances on a 2018 W-4, is paid $1,500 in federal income taxable wages biweekly, and her year-to-date wages are $15,000. She has had federal income tax withheld on previous paychecks, and she receives a bonus of $2,500 on July 15th of the year. Her employer treats the bonus as supplemental wages and can withhold $550 in federal tax because 2,500 times 0.22 or 22% is $550. Questions on that? That one's easy because you don't have to do anything other than the math behind it. So those are nice. So the aggregate method, people can get kind of confused by this, but the aggregate method is basically where you combine the supplemental wage payment and the wages paid during the current or most recent payroll. You determine what the federal tax would have been withheld if those two had been combined, and then you subtract whatever you've already withheld. So for example, if you were paid $1,000 in wages, and then they gave you a $100 bonus, then the aggregate method means we would take the $1,000 that you were already paid, the $100, add them together, figure out what your federal tax would have been had you been paid both of them at the same time. And then you're going to subtract whatever they withheld from the $1,000 from whatever they should have withheld from the total amount, and that's the additional amount that they would withhold. So that's the aggregate method.
Can I ask a question?
Yeah.
So the optional flat rate, that 22% or the 37%, is that just the federal income tax? And then you still have to take off Social Security and Medicare if they would have met those thresholds? If you're over
So if they have supplemental wages that are over $1 million, they obviously would have already met the Social Security wage base. So there wouldn't be any Social Security withheld from it. But yes, you would absolutely have to withhold Medicare. Medicare is withheld on all wages. And since that person's earned over $1 million just in supplemental wages, that doesn't even count what they've earned in regular wages, then they're definitely over that additional Medicare limit at $200,000 as well. So you would have to withhold additional Medicare on top of the federal income tax. So yes, Manon, the 22% or the 37% is just your federal income tax. That is not Social Security or Medicare. So it would be withheld in addition to Social Security and Medicare, depending on which ones need to be withheld based off of where you're at. Good question. Okay. All right. So example, Jack, who claims married filing jointly separately with no, who claims married filing jointly with no other adjustments on his 2021 Form W-4 is normally paid $1,500 biweekly in federal income taxable wages. Between paychecks, he receives a production bonus of $400. Using the aggregate method that we just talked about, we're going to figure out how much his taxable wages or how much tax we're going to withhold from the bonus. So we're going to take his $1,500 that he was paid, his $400 bonus, we're going to add them together to get $1,900. If we look at that, where his normal taxable wages fall on the bracket, we get that he should be withholding $54. If we look at the two together, we get 98. So we're going to take the difference between those, 98 minus 54, and we're going to withhold 44 from the bonus because the 54 was already withheld from the 1,500. So again, not terrible, just make sure that you're following the steps. So you're just going to take what the combined amount would have been, what we would withhold, subtract out what was already withheld, and take the difference. That's the aggregate method. So using the optional flat rate method and the wage bracket method, and I gave you your table there, and this is a quiz question, so go ahead and type your answer with your name in the chat so that we can make sure you get credit. We want you to calculate the employee's federal withholding based on the following information. The employee is paid $915 semi-monthly and a $430 bonus included with his paycheck. And remember, we're using the optional flat rate method and the wage bracket method together. Okay. So the employee's total year-to-date wages are $25,000, and the employee claims single one allowance on their 2018 Form W-4. So because he has a 2018 W-4, I gave you the table for W-4s that are 2019 or earlier, not the table for 2020 or later. Okay. They told you that the person's year-to-date wages are $25,000. That's important because it tells you whether you're using 22% or 37%. Since it's less than $1 million, you're going to use 22% on the bonus because that's the supplemental wages. So if we look at his $915 that he regularly makes, we can see that he would normally have $61 withheld because he's claiming one allowance. And then we would take his bonus and we would multiply it by the 22%, because again, we're using the optional flat rate method and the wage bracket method. We are not using the aggregate method on this example. So we're doing both the optional flat rate and the wage bracket. So we're going to take his $61 that should have been withheld from his regular payroll. And then we're going to use the optional flat rate method on the bonus. So we calculate 22% of his $430 bonus. We get $94.60. Add that to our $61 and we get $155.60. Questions? I will tell you, they like to trick you. Not necessarily trick you, just you want to be careful. Like we just talked about, reading is so important. Make sure that you understand what they're asking you to do, whether they want you to use the aggregate method, whether they want you to use the optional flat rate method. Just make sure that you read, because that's really where they're going to get you. Good job, guys. So let's talk about Social Security taxes. We've talked a lot about federal income tax withholding. We haven't really talked about the other taxes, which are Social Security, Medicare. So let's talk about those now. Calculation of Social Security taxes, it's required for everybody. Everybody has to have Social Security tax withheld. The only caveat to that, and this is not going to come up on the CPP exam, but especially in Colorado, we have some employers that are part of a special group of people, and they can participate in a special deferred compensation plan, which takes the place of their Social Security tax. So they're not going to get Social Security when they retire. They're going to get it from their private retirement company. Teachers, anybody who works for the state of Colorado is examples of people that have that. So I used to be a teacher. I paid into what we call PARA, which is that Colorado. So for those years that I was a teacher, I did not pay into Social Security, and I will not get Social Security based off of those years when I am old and retire. I will get something from that private retirement. So anyways, rule of thumb, especially for this test, is that everybody pays Social Security tax, regardless of age. You do pay it up into the limit. The limit for 2021 is $142,800. This is raised up. It raises up every year. So we're up to $142,800 as of 2021. The rate is 6.2% for the employee, 6.2% from the employer. If you were to combine those two, you would get 12.4%. The max amount that can be withheld for the whole year is $8,853.60. And to get that, we just did 142.8, the limit, times the 6.2%. That's the max amount that can be withheld from an employee's checks for the whole year of 2021 for Social Security. That's also the max that the employer would pay per employee. So as of December 17th, Brad had received $142,200 in wages. On December 18th, he was paid $1,500. Brad's Social Security and Medicare tax withholding from his December 18th paycheck were calculated as follows. So he had $142,200, then he was paid $1,500. That $1,500 is going to put him over that Social Security wage limit. So we're not going to take Social Security on all of the $1,500. We're only going to take Social Security on the portion that gets him to that wage limit. So if we look at how much of his bonus should have been taxed for Social Security. There's only $600 that got him up to that 142.8 limit. So we're only going to calculate Social Security on $600. So 600 times 6.2% is $37.20. Medicare tax is 1.45% of your wages. That's the standard Medicare rate up until 200,000. Once you hit 200,000, you as the employee have to pay additional Medicare tax on those wages. An employer does not have to pay additional Medicare tax. So the employer will always pay 1.45%. In Medicare, the employee will always pay 1.45%, and they will pay 0.9% of additional Medicare on anything over 200,000. This $1,500 payment to Brad is not putting him over 200,000, so we don't have to worry about any additional Medicare tax. So the Medicare tax on his $1,500 payment is just going to be $2,175, or 1.45% times 1,500. So to get the total amount that we would pay in Social Security and Medicare tax, we're going to add those two numbers together and get $58.95. Questions on that? When the employee hits that limit, we have to figure out how much of that payment should have been subject to Social Security tax, and then the rest of it is not subject to Social Security tax. Perfect. I will tell you, they will give you questions that have that limit, and they're not going to point that out to you. So make sure that you're paying attention. And I will tell you, and this comes up later, but they like to, because all of these questions are multiple choice. So you have 4 choices on each question. I will tell you right now that one of the choices is going to be if you calculated Social Security on the entire $1,500 payment. They're going to make that one of the choices because it's going to be a common mistake. So read. Make sure you're reading the question and making sure you're answering exactly what they're asking you to do. So pop quiz. If you had printed out the slides, I did find a mistake on this one today. So anyways, I changed it. So your slide may look a little different than mine does right now. So an employee with year-to-date taxable wages of $137,500 is being paid $6,500 for the last pay period of 2021. How much Social Security tax? We're only asking for Social Security tax must be withheld from the payment. So let's see if I did my math right. If the employee is at 137.5 and the taxable Social Security limit is 142.8, then I get that only $5,300 of this payment is taxable for Social Security. Did anybody else get that?
That's what I got too.
Perfect. So if you multiply 5,300 times 6.2%, I get 328.6,
Yep.
which is C.
That's what I got too.
Perfect. D is the trick answer. So if you figured Social Security on all of that 6,500, it does come out to 403. So like I said, they like to throw you off. They like to put those common mistake question or answers as answers to try and trick you. Okay. Questions on that one? Okay, so let's look at Medicare a little bit deeper. I told you that Medicare has a $200,000 limit, and it's not to stop Medicare taxes, it's so that you actually have to start paying more in Medicare taxes. So $200,000, you have to start paying additional Medicare tax. The standard Medicare rate is 1.45, as we've already talked about, and the additional Medicare rate is 0.9%. So if Elizabeth was paid $3,500 and had year-to-date Medicare wages of $199,000 at the end of the prior payroll, then her Medicare tax would have to be calculated as on this slide. $3,500, the full payment, is going to be taxable for the full Medicare amount of 1.45%. So if we do that math, we get $50.75. But then she was at $199,000. So she was $1,000 away from that additional Medicare tax limit, which means that $2,500 of this $3,500 payment is also subject to that additional Medicare tax of 0.9%. So if we multiply 2,500 by 0.9 or 0.9% or 0.009, if you're typing it into a calculator, then the additional Medicare tax is $2,250. Add the two together, and the total Medicare tax withheld is $73.25. Again, it's important to remember that that Medicare, the additional Medicare, is only the responsibility of the employee, not the employer. Questions? All right, so voluntary deductions, we're going to talk a little bit about. They can be like things like union dues, charitable contributions. A lot of people contribute to United Way deductions, things like that. So those can all be considered voluntary deductions. For example, Leah has $50 withheld from each monthly paycheck in 2020 for United Way. Her employer is required to report the amount on her pay stub in box 22. I'm sorry, box 14 on her W-2, or they can report it on the pay stub in order for her to claim a charitable contribution. So she can be able to take that to her accountant at the end of the year when she files her taxes and be able to get a credit for that because it's a charitable contribution. Taxes have to be paid by your employer, obviously, when making federal tax deposits after each payday. And when filing the Form 941 each quarter, the federal tax liability must be calculated, and it's going to be all of the federal taxes that you withheld from the employee and as well as the employer side of those. So all of the federal income tax you withhold, all of the Social Security that you withhold, all of the Medicare that you withhold, all of the additional Medicare that you withhold, as well as the employer's share of Social Security and Medicare is what goes into the tax liability for federal taxes. What time is it? 12:43. Okay, so let's look at gross ups a little bit. Gross ups can be intimidating and scary, and sometimes we're really happy that our software does gross up calculations on our behalf and we don't have to do them by hand. But if you're taking the CPP exam, you do have to do them by hand. So the basic idea for a calculation of a gross up is the gross up amount is going to be equal to the desired net payment divided by 100% minus the total percent of all tax paid. So in order to figure this out, the first thing we need to figure out is how much tax they're paying. So we need to add in all of their tax amounts for federal income tax, Social Security, Medicare, state income tax, local income tax, any of the taxes that you're going to be grossing up. You need to figure out the total percentage of those. You're going to take that total percentage and you're going to subtract from 100. That's the gross up rate. And then you're going to divide the desired net payment amount by the gross up rate. That's going to be the gross amount. My advice to you on this is to always check your gross up calculations on your test. You will have time, as long as you budget your time correctly, to go back and do verifications on these calculations on your CPP exam. I would really highly suggest that because these are always able to be checked. So we'll go through those. So here's an example. Generosity Inc. wants to give her employee, Linda, a $6,000 year-end bonus. To ensure that Linda receives the net amount of $6,000, Generosity agrees to pay her federal income tax, state income tax, and Social Security and Medicare on the bonus. The bonus is supplemental wages for Linda. Hint, 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 that tells us something about how we're going to withhold federal income tax. At the time of the bonus is paid, her year-to-date wages are $45,500. Hint, 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 that also gives us information about what percent we're going to use for those federal income tax. So let's look at how the employer is going to calculate the gross up amount for her bonus, and her state supplemental wage withholding rate is 3.5 for her state income tax. So that is going to factor into this. So we're going to first calculate all the taxes she has to pay. So for federal income tax, we're going to put 22% because they told us this is a supplemental wage payment. And they also told us that she only has $45,500 so far this year. So we don't have to use that 37% because she's not over $1 million. So we're going to use 22%. They told us that her state has 3.5% for supplemental tax rate. We already know she has to have Social Security and Medicare because she only has $45,500, which means she's below the Social Security limit and she's not over the additional Medicare limit. So those are my taxes. I'm going to add them all together and I get that she has to pay 33.15% in taxes. That was step one. Step two, we're going to figure out what we're going to divide by. So we're going to take 100 and we're going to subtract what we just calculated of 33.15%. And we get 66.85%. That's the percent that we're going to divide by. So again, our calculation, we're going to find our gross up earning. We're going to take what we want to pay Linda, which is $6,000, and we're going to divide it by the percent that we got in step two, or 100 minus all of the taxes that the employee has to pay. So we're going to take 6,000 and divide by 66.85% or 0.6685. Again, be very careful. Make sure that you're moving your decimal correctly when translating between percent and decimal. And you get $8,975.32. That's the amount that's going on her W-2, even though she's only getting $6,000 in her pocket, because the employee is paying all of those taxes on her behalf, which is super nice of her employer, by the way. I told you my greatest word of advice on gross up calculations is to check your work. You can always check your work. So you got to an answer. You got that $8,975.32 was your answer. You can check your work. So we're going to take that number and multiply it by 22% for the federal income tax supplemental rate. And we get $1,974.57. Same for state withholding. We're going to multiply by 3.5. We're going to multiply by 6.2 for Social Security and 1.45 for Medicare. Get all of those numbers. Take your grossed up amount of $8,975.32, subtract all those taxes that you just calculated, and do you get to 6,000? That's the question. So those gross up calculations can be tricky, and I will tell you they get trickier because of wage limits and things like that. But you can always check your work. So let's look at them when they are trickier. So this one crosses the Social Security wage base. So an employer wants to gross up a relocation bonus of $5,000. The employee's year-to-date earnings are $1,392. The employee's state has a supplemental tax rate of 3%, and there is also a local supplemental tax rate of 1%. So this person has a lot of taxes coming into play. So the Social Security wage base for 2021 is $142,800. This bonus payment is going to put her over that limit. So we need to figure out how much of the bonus needs to be grossed up for Social Security. So to do that, we're going to subtract, and we figure out that the amount of the bonus that's subject to Social Security is going to be $3,600. If we take that $3,600 and we multiply by 6.2%, we get 223.20. That's the amount of Social Security that has to be paid on that bonus amount. So instead of just using $5,000 for our bonus or our gross up calculation, we're going to use $5,223.20. So we're going to look at the taxes that she has to pay. 22% in federal, supplemental rate, 1.45% in Medicare, 3% in state supplemental, and 1% in local. You'll notice that there is not Social Security in that one anymore. The reason is because we just did the calculation on the part of the payment that was subject to Social Security, because not all of the payment is subject to Social Security. So we're not putting that into our equation anymore. So this time we're going to take $5,223.20. Again, that includes that $223.20 that we came up with for Social Security. And we're going to divide it by 100 minus the 27.45%. And that 27.45% is all of the taxes that she does have to pay added together. If we do the math, we get that the employee's grossed up amount is going to be $7,199.45. On her W-2, boxes 1, 5, 16, and 18 would have that full amount added to them. Box 3, on the other hand, is only going to have $3,600 added to it. And that's because that's the only amount from the $5,000 bonus that brings her up to the Social Security limit for the year. So that's what that piece looks like. And again, I absolutely encourage you to double check your gross up calculations, because you can always double check your gross up calculations. That being said, I've already told you that this test is multiple choice. So in theory, you've been given 4 answers. You could back into your answer for the CPP exam, given multiple choice. So if you do your math and you don't get an answer that's in your multiple choice, you may think backwards. Hint. Questions on this one where we split it out, we did the Social Security separate, and then we took that amount and we added that together with the regular bonus, and then we did the calculation for the rest of the gross up. Okay. Grossing up with a 401k can be a little bit tricky. Reason being, 401k deferrals are not subject to federal or state income tax, but they are subject to Social Security and Medicare. So you have to look at this in 2 pieces, because the gross up, the entire deferral piece is subject to taxes for Social Security and Medicare, but not for federal or state income tax. So for example, an employer wishes to pay the taxes for an employee who receives a $1,000 bonus and has a year-to-date of $50,000. The bonus is eligible for 401k deferral. However, the 401k deferral is based only on the bonus amount, not on the employer paid taxes. So the employee has elected to defer 5% into the 401k. The employee's state has supplemental income tax at 4%, and the employee will not cross the Social Security wage limit with the bonus payment. Yay, we don't have to take that into account. The employee is to receive the bonus amount less their deferral to the 401k. So the very first thing I'm going to do is I'm going to look at that bonus, figure out how much of that is going to the deferral. So they said 5% was going into that 401k. So 1,000 times 5% is $50, which means that the employee needs to receive $950 in their pocket at the end of our calculation. It also means that the amount that's subject to federal and state withholding is $950. So if we look at the Social Security tax on the deferral, because that $50 deferral is taxable for Social Security, we multiply $50 times 6.2 and get 3.1. Medicare, same idea. Multiply 50 times 1.45 and we get 73 cents. We take those 2 amounts and we add them to my $950, I get $953.83. So that's the amount that we're going to use in our gross up calculation. For the taxes that the employee does have to pay, we're going to use 22% for federal. We're going to use 4% for state, because that's what they told us. And then again, we have the 6.2 and 1.45. So if we add all of those percentages together, the employee must pay 33.65% in taxes. So that's the amount that we're going to put on the bottom of our fraction when we do our equation. We're going to do 100% minus 33.65 and get 66.35. So if you take that $953.83, which again is that the amount the employee needs in their pocket plus the small amounts of Social Security and Medicare for the 401k deferral, we get $1,437.57 should be the gross up calculation. Okay. So if we verify, because we have to add back in that $50 for the elective deferral. So we're going to verify. If we put $1,487.57 minus all of our taxes, which our federal withholding and our state withholding are going to be the 22% and the 4%, but we're only multiplying by $1,437.57 because we have to take out that $50 deferral. Then we take out the $50 deferral. Now, our Social Security and Medicare are calculated on the full amount. And if we take our full amount and we subtract all of that out, we do in fact get $950, which was what was supposed to go into the employee's pocket. These questions can be difficult. And again, I tell you that the saving grace for these is being able to verify your answer, because you can back into it every time. Manon did send out these slides. I know I'm going fast. This is a big section as well. So if you guys have any questions on these, feel free to give me a call or shoot me an email. I'm happy to sit down and do extra examples with you if you would like. We are almost out of time for today, so I don't know that we want to go through that one, but we can do a pop quiz really quick because you guys already know the answer to this one. Go ahead and type your answer in the chat. When calculating a gross up for an employee working in a state with no income tax and year-to-date wages of $50,000, the employee's desired net payment is $5,000. And that needs to be divided by 100% less which taxes? You guys are awesome. This person had no state income tax, but we do have to divide by federal, Social Security, and Medicare because they were not over the Social Security limit. So good job. It's 12:57. Should we call it a day? I'll go back and look at that one calculation tomorrow for the over the Medicare limit. Okay.
You guys have locals in Colorado?
Not very many, but we do have a couple over on the west or on the eastern slope in Denver. They're occupational taxes mostly though. So nothing like you guys have in Pennsylvania. We had a really big client who was an oil field client, and they were in Pennsylvania. It was the bane of my existence for a while.
Oh yeah. We even have some where it depends on the side. The one side of the street is one, and the other side of the street is another.
That's just crazy. I don't know how you guys deal with that.
We had an overhaul of the system, 10 years ago, and it was called Act 32, and it was, yeah, I got into payroll before it happened and then walked through it, and we didn't think it was ever going to make sense. Yeah.
Hands down to you guys, because gosh, over here in Colorado, we don't do crazy stuff.
Yeah, computer says systems just don't like it. That's all.
No.
Anyway.
No, not at all.
That's all. Okay, go ahead.
That's all I had for you guys for today. Like I said, I'll go back to that one question tomorrow real quick, and we'll look at that. Other than that, we'll call it a day. Manon, did you have anything to add? Okay. Thank you guys. Talk to you tomorrow.
See you, Melissa. Thanks.
Bye. You're welcome.